This is Market Pulse by Faster Forward from Northern Trust Asset Servicing, the podcast where experts share their insights on current trends in the markets and financial landscape. I'm Nadia Cobalovic, Global Head of Omnium Platform Services at Northern Trust. I'm very excited to be serving as the host for today's episode. Joining me is Grant Johnsey, Head of Client Solutions, Banking and Markets Americas at Northern Trust. Grant, welcome back. It's great to be back here with you in a new year. I'm really excited to be doing this again. I thought we would just kick things off a little bit and talk a bit about what you're seeing in the markets as we head into the early part of this year.
Hey, thanks, Nadia. It's good to be here. I appreciate the intro. So this year, I think, is really going to be a focus on growth. That's really the big word this year. And specifically, what I want our listeners to really be thinking about are potential growth scares. So we come into this year, we've got pretty high valuations, especially in the U.S. equity markets, and strong expectations of earnings growth. Not just in the U.S. actually now, but you're starting to see more non-U.S. investors expect growth in emerging markets in particular, and even in other developed markets. So this year's really a focus on growth this year. What I worry a little bit about if a growth scare comes about is how the market will react. So we saw a growth scare, for example, in July and into August of 2024 over the past summer. And the growth scare then was around unemployment. If you recall, starting around the third week of July and into early August, the U.S. stock market sold off about 8%. And the growth scare was what was going on in unemployment. Was that going to be a potential for recession? What I really want listeners to take away from this more than anything else probably in this discussion is when you are in a strong bull market cycle like we are, it's not just the upswings you have to pay attention to, it's those dips, it's those corrections. Why are those corrections happening? Is that a chance to buy, dollar cost average and buy a little bit lower as the bull market rips higher? Or is it a sign that perhaps growth is slowing or there's some risks emerging on the horizon? Right now, I don't see anything that's really going to stop the bull market, but the growth is the number one focus this year of the market, high expectations for that, and so beware of growth scares.
What about just in terms of the bond market and bond spreads? We certainly saw some tightening in spreads in 2024 and early part of this year. We can be an indicator of a bullish market. Can you talk a little bit about what you're expecting in terms of bond yields and where you see things going?
2024 was one of the best years for bonds, in terms of inflows at least. $600 billion went into bond funds in 2024, which is a record. So when you have that type of money going to bond funds, and particularly into money market funds as well as into corporate bond funds, you're going to have yields that spreads that really tighten, and especially between corporate investment grade bonds and treasuries. So typically you would see corporate bond spreads over 100 basis points. We have been inside of 100 basis points now for quite a few months, including now. So that's a sign that investors are risk on, happy to take on the extra credit risk associated with corporate bonds. And that makes sense, right? Balance sheets, corporate balance sheets, especially in the U.S., are very strong. And as I mentioned earlier, there's strong expectations for growth. Now, going forward, most Wall Street analysts are predicting short-term rates to come in a little bit this year, and long-term rates, in particular, the 10-year, to be a little bit higher this year, to actually increase. So that would infer a normalizing yield curve, moving away from the inverted one that we've seen for the last 2 years. So that's something to keep an eye on. The other interesting pivot that might be happening is what the Treasury Department is going to do in the U.S. So we had Yellen, who is now left, is the head of the Treasury Department. She had in 2022 and early 2023 was mostly issuing U.S. Treasuries on the shorter end. So the United States has to constantly issue more treasuries, not only to fund the current deficit, but just as other bonds come up for maturity. And over the 2022 and early 23, Yellen and the Treasury Department were mostly financing the U.S. debt and with short-term T-bills. Okay, that started to change in 2024. The Treasury Department started to go further out in the yield curve and issued what we call coupons, which is a mix of notes and bonds, so further out into the yield curve. And as that happens, rates started to go up a lot more on the longer end of the curve. And right now, the term premium is as high as it's been at least 10 years, meaning right now investors are demanding a lot higher yield for longer dated bonds. So I expect that to continue. The U.S. has a major deficit problem, as everybody is aware. But what I would encourage the listeners to this podcast to pay attention to is, what is the Treasury Department going to do under the Trump administration? So that's a big question. If they start to issue T-bills again and go shorter end, it might alleviate some of that pressure on the longer end of the curve. But if they continue to issue debt on the longer end of the curve, it's going to push longer rates up, probably the yield premium, the term premium up as well. So, and that would mean long-term rates go a bit higher. Two more really interesting notes on yields. December, according to Redfin, was the biggest month of contracts, home contracts that were canceled in the United States. In all the years they've been tracking that. So something like 17% of all contracts for homes that were going to go into closing were actually fell through in the month of December. And it's the same time that mortgage rates went higher. So there might be some impact on the long rates from being higher on the home market here in the U.S. So that's an interesting trend, and your listeners can see that Redfin publishes that data monthly. So that's another area to keep an eye on, is what's happening to the home market in the U.S. if longer-term rates do trend higher.
Just kind of coming off the back of housing, how's that translating in auto sales? Was there any movement in the markets that was interesting in terms of auto loans in December or since?
Auto sales have actually been pretty strong. 22, 23, and into 24. Every month-over-month metric, by and large, was showing higher auto sales. So it seems like on the auto sales side, which usually uses kind of the 7-year Treasury as the benchmark rate, that there has been pretty decent purchasing of autos with credit because those sales figures have gone up year over year for 3 years in a row. So, but in the housing market, home sales have generally been rising. It's just been recent that you saw that particular weakness. And, as we report this podcast right now, 30-year mortgages are over 7%. So that's just an area in the home side to keep an eye on that does not seem to be translating yet onto auto sales. In fact, auto sales suggest that consumers in the U.S. are getting more used to this higher for longer rate environment. But I don't think home buyers yet have adjusted to that yet.
Okay. Well, selfishly, I'm disappointed on auto sales because my car is 10 years old, and so I was really, really hoping for some softening in the market to give me some negotiation power.
Financing rates are going to remain higher.
Okay. Let's pivot a little and talk about the S&P. So we saw some really strong returns over the last 2 years in the S&P, somewhere around 20%. A lot of it driven by the Mag 7, especially last year. Want to get your thoughts on how sustainable that might be. And I know we're not making predictions, but any indicators you might see. And also how that's tying back to performance in the Mag 7.
So 2 years in a row in the S&P 500 have been over 20% in terms of return, 2023 and in 2024. So 2 consecutive years of 20% growth. So one of the things I looked at was, well, how historically has that played out? How many times has that occurred? And the answer is, since 1950, that's happened exactly 8 times. And in 6 of those 8 times, the third year, the S&P 500 was actually higher. So just because we've had 2 years of 20% plus returns and back-to-back consecutive years in the S&P 500 index does not necessarily mean a third year is going to be weaker. The other thing to consider is how long this bull market has been. It's a little over 2 years old right now, and the shortest bull market cycle in recent history, at least going back, I'd say at least to the 70s, is about 5 years. So it would suggest just because we've had a couple of really good years in a strong bull market does not necessarily mean that we're going to have a progression to the mean, that we're going to have a sell-off in year 3 just because we've had 2 good years. So that's the first thing that I would suggest that I would really want people to take out of their mind that necessarily is going to cast a pall on the year. Now, what is really interesting right now in the S&P 500 is the sentiment of retail investors versus institutional. So for those of the listeners that have listened to this podcast before and heard me speak, I always pay attention to the retail investors because they control more than 50% of the U.S. market. They own more than 50% through direct investments and mutual funds. And so oftentimes as they decide, as they go, the market goes. And the AAII, the American Association of Institutional Investors survey that comes out weekly, and again, anyone can look at this, it's publicly available. the number of bears now is greater than the number of bulls. Very unusual and surprising given the strong market that we're in. The institutional fund managers that have been surveyed are still bullish. So you have this inversion right now that's happening between retail sentiment and institutional sentiment. And I was particularly surprised that the result last week came out was still kind of bearish from institutional investors because we've actually had a decent start to the year in the U.S. equity markets at least. So that's something to really keep an eye on. The last time that doesn't diverge very much, that sentiment, and the last time it diverged was in 2021 and kind of in front of a bad year that we had, as you may recall, in 2022 in the U.S. equity market.
Interesting. What about non-U.S. markets, whether they're developing markets or developed markets outside of the United States?
So growth expectations, as I mentioned earlier, are higher than they have been historically, at least in recent years, particularly in emerging markets. So there does seem to be a growth narrative coming out in the overseas markets. But what's really differentiated the U.S. equity market from the non-U.S. is the fact that in the U.S. market right now, you've had this Goldilocks scenario where both growth and valuation have been increasing by double digits. And that's fairly rare even in the U.S. market. So 2024, both growth and valuations increased by 10% or more, right? That's only happened really 3 times, at least in my professional lifetime. It happened in the early 2000s, around 2003, and it happened in the mid-90s, around 96, 97, as I recall. So that combination of really high growth, more than 10%, combined with valuation growth, fairly unusual, and that's the reason that the U.S. market has really done much better than the foreign markets on the equity side. That does seem to be maybe catching up a little bit on the non-U.S. side. And as I mentioned, particularly the emerging market expectations of growth are much higher.
Are you thinking about any changes in terms of interest in the markets, especially U.S. markets, from international investors as we embark on a old new president in the United States and any impact that might have in terms of how global investors are looking at or thinking about U.S. markets?
We've talked about this in the past podcast. I mean, we're long in the trend of U.S. equities outperforming non-U.S. It's been going on for 16 years now. It's a three standard deviation difference. So it's a big outlier of performance that the U.S. equities have been putting on versus developed market peers, for example. So that can't continue indefinitely. A lot of that growth has been in obviously technology and telecom and some of the stocks that have been in the news a lot. Right now, the TMT sector in the U.S. is priced twice as high as the non-U.S. sector. So you're seeing valuations and favoring of these U.S. stocks very, very strong still. As long as the U.S. dollar remains relatively strong, I think those foreign investors will keep their money in those technology stocks. So that's positive. But if you see the dollar start to weaken, which would then, of course, offset their local market equivalent returns, you might see some of those investors redeploy those monies into other markets. But right now, we're still seeing a lot of foreign buying of U.S. equities and not a lot of people selling and repatriating those monies from those investments.
You mentioned some uncertainty in terms of what the Treasury might do as we move forward. And we've talked about interest rates in the past, ad nauseum probably. Any thoughts just in terms of where we are with interest rates, any actions the Fed may or may not take? I know unemployment will have a big indicator or have a big force in terms of what things look like in the short term and longer term. But any thoughts in terms of where we may be going with interest rates?
It's a tough one, to really project because you do have the market right now expects there to be still some cuts by the FOMC this year, but there's a rising probability, at least in the options market, of a Fed hike later this year. So there's some hawkish sentiment out there. You're seeing it in Japan as well, so it's not just in the U.S. And I've looked at forecasts from a number of different pundits, and they really diverge. It's really hard to say right now. I think long term, what investors need to take away is we are in a period of more inflationary pressures than disinflationary, right? Think about tariffs, workforce shortages, right? Commodity pricing and the need for more energy, the need for more rare earths, et cetera, is all going to be inflationary to some degree. So longer term, managing inflation is going to be a struggle. by the various central banks, including the Fed. So that's kind of longer term trend. What's going to happen this year? It's a tough one. What I will say, what people kind of forget a lot of times is when interest rates are rising and then bond yields are rising, that's usually a bad sign for the stock market. And in fact, when those situations, when yields are rising, which is about 45% of the time historically, the equity prices on a lagging basis usually are down about 5%. Conversely, when yields are falling, which happens around 55% of the time, the trailing returns of the S&P 500 are about a positive 12%. So how that plays out is going to eventually have an impact, at least on a trailing basis, in the equity market. So definitely something that we need to keep an eye on. It's really hard right now at the beginning of the year to project how we're going to end up, but I do think those longer-term inflationary pressures are going to be there, and a lot of it does depend on the tariffs, right? We're still early in the Trump presidency here. Seeing how those tariffs play out is going to also be a part of where the interest rates go and inflation.
Okay, great. You mentioned the relative strength of the U.S. dollar. Curious on your thoughts in terms of gold and where those markets are. We've talked about commodities a lot in the past, and so anything else that you may have some thoughts on, feel free to throw out there. But I'm really curious on where you see gold markets and where you think things might be going.
So at the January market pulse from 2024, I had said that if gold was going to break out, this was going to be the year 2024, and it did. But what happened, most of the breakout was in the first 5-6 months of the year. Gold hit 2,700 an ounce or thereabouts by spring, early summer, and then the price just sort of languished, and it kind of stayed in this 2,600 to 2,750 band until relatively recently. It seems to be starting to try to break its way back out. Now, the reason for that, in my opinion, was China, because of all their issues going on in their home market and their big debt crisis. Their central bank, the People's Bank of China, ceased buying gold for the reserves around May. They didn't buy gold from June all the way through until they started again in November. And then they also bought, it looks like, in December. So if China starts buying again to put more gold into their reserves, then I think you're going to see gold prices march higher. As we record this, People's Bank of China has about 5% of their reserves in gold, which is much, much less than what you would see in the U.S., the European Central Bank, or the U.K. So my guess is they probably want to get closer to 10% of their reserves in gold. So they have a lot of gold buying left to do, and they're buying a lot of it. The one trend that's changed this year versus 2024 is the public buying of gold, so people buying it for jewelry or just to store. I'm seeing less buying of gold in particularly the Far East. That's where a lot of the physical gold gets actually bought, is in a place like India and China. Last year was the year of the dragon. People were buying a lot of gold to celebrate. It's a lucky year. This year, I don't see that same catalyst. So you might see a little bit of buying by the public, but the central banks are going to keep buying. And there's a lot of central banks, obviously, that want to either de-dollarize or build up their own reserves as the global geopolitical crises emerge. So I think a lot of countries want to be prepared for that.
I've asked you a lot of different questions. I'm curious on what our clients are asking you. Is there anything that we haven't touched on that you might be hearing from clients?
Well, the number one question right now that I'm getting, and I don't have all the right answers for it yet, is how is the new incoming administration going to impact global markets? It's really hard right now because we're so early into the Trump administration to see what's rhetoric from the campaign trail and what's actually going to happen. So it's almost the same as if we were recording this 5 years ago, trying to predict how the pandemic and COVID was going to go. So we can go into a lot of what ifs and scenarios, but I don't want to waste a lot of people's time with it. What I will say, the one thing that I can say that looks to be evolving out of this is in the energy markets. So I would encourage anyone who's listening to this, who's interested in the impact, is to go look at the Liberty Energy's website. And on it, they have something called 10 Key Takeaways on a paper that they published last year. So you can literally just type Google Liberty Energy 10 Key Takeaways. Now, the reason that's relevant is the CEO of Liberty Energy is a gentleman named Chris Wright. Chris Wright has just been appointed, or is being in the process of being appointed, as our Secretary of Energy. And if you read the 10 takeaways, it is more or less a play sheet for how I believe the Trump administration is going to play the energy in their new administration. And really, in short, it's going to be refocus on hydrocarbons, particularly natural gas, more LNG or liquefied natural gas exporting facilities and exporters. And I think they really want to use this to support or to influence allies and trade partners. So the U.S. is going to go all in on energy with the Trump administration. You're going to see the U.S. back out of a lot of clean and green energy initiatives, and they're going to push hydrocarbons, particularly natural gas, because that's what is right now the easiest for them to export. The U.S. is already the largest oil producer in the world. It is the largest natural gas producer in the world. We have the third largest natural gas reserves that are known. I think there's something like 100 plus years of natural gas reserves at current utilization in the United States. So a lot going on there. It's worth probably another podcast or discussion, and I'll probably be speaking to folks about it. But that's a big focus. And what that actually might mean is actually lower energy prices. And that's a really effective way if you think about it. If you lower energy prices and oil prices, right, it's good economically. And it's a way that the U.S., if it so wishes to, can undermine, say, Russia, for example, because lower energy prices, lower oil prices mean they also make less in their exports and so on and so forth. So, and you're even seeing it right now, like the demand for LNG carriers. So these are the giant ships that carry the liquefied natural gas. Those orders are also picking up a lot. So, there's a lot of anticipation from investors that the U.S. is going to continue to focus on hydrocarbons and hydrocarbon exports.
Is there any connection, do you think, and this isn't a technology podcast, but I think it's tied in some ways around AI and the buzz around AI and the extreme energy needs in terms of driving not just where we are with AI, but actual growth in the availability and the accessibility and speed and what have you. Is there any tie back there as you think about the stance in the energy markets and how we might be positioning ourselves longer term, and especially those who are close to the administration?
Oh, absolutely, Nadia. I mean, you nailed it on the head. If electricity usage in the United States for the last 15 to 20 years has been more or less flat until the last year, and it's really starting to pick up more. The servers that needed to power AI are requiring massive amounts of energy. We did an energy podcast last year, and one of the most fascinating facts that I learned in talking to people is that the NVIDIA GPUs, those graphical processor units that they've been selling, if all those were plugged in and used to full capacity at the same time, it would take more electricity than New York State consumes in a year. So you're talking about a lot of energy usage. Most of that energy, by the way, goes to cool those GPUs. Nonetheless, it's a lot of energy to keep powering all the AI that's coming on, and that's a big part of it. But what's really interesting is economic growth requires energy, and when energy prices are high, and the basket case of this is Germany. Germany's continuing to face manufacturing and industrial declines. Their economy's been going sideways, even slightly down over the last 3 to 5 years. And that's a large part because their energy prices are so high, it makes them operate at a competitive disadvantage. So you're spot on. The technology is going to require more and more electricity, which you need more sources for. And, the reality of it is things like solar and wind don't operate 24/7. But nuclear and hydrocarbons can be much more reliable and, in many cases, inexpensive, sources of energy. So I think that's where you're going to see the U.S. tend to go.
Right. Anything we haven't talked about that you want to make sure we touch on?
I think the main thing is the growth scare. It's what I said at the outset. So if I could just hammer that point one more time, I believe we're going to see some growth scares during the year. And really what I want our listeners to think about is that an opportunity to buy lower dollar cost average in a bull market? Or is that a real change in the direction of the markets and the economy? And if you combine that with the tremendous amount of complacency right now, we didn't really talk about the options market, but a lot more calls that are being purchased than puts. So still risk on environment and the options and derivative markets. So if you put all that together, right, it looks like there's nothing that I can say right now that's going to upset this bull market. at least on the near horizon, absent of geopolitical concern. But you're going to have some growth scares whenever you have these valuations that are so high, particularly in the U.S. So something to keep an eye on. And from the other markets, there's a lot of good markets that are underpriced. So there are places to go if there are concerns about growth in the Mag 7 and in U.S. equity large caps.
Thank you, Grant. And to our listeners, thank you for tuning in to Market Pulse by Faster Forward.